Okay, good afternoon, everyone, and welcome to our meeting of the Financial Reporting Committee of the Institute of Management Accountants with the FASB board members. Really excited to see everyone here, and thanks in advance for all your time today, as well as all the prep time you provided to us ahead of this. So I think we're going to get started. I think the majority of the agenda now is to discuss comments that we had on the board's recent agenda consultation. And then I think we'll wrap up with maybe some commentary on some of the ongoing projects. So I think just to kick it off with a few of the highlights before we jump into discussion, I think in our letter, the top priorities that our committee flagged, I think was to align or to continue work on aligning business combination accounting with accounting for asset acquisitions. And I know that there were some efforts made a few years ago that we subsequently dropped. And I think we all are in agreement that this is a inconsistency out there in practice that would be very beneficial to preparers, auditors, users to address. The second topic we wanted to raise is one of our priorities, and we will have representatives speaking about these in more detail during this meeting, is for the board to explore looking into a model that the IASB is currently exploring, something along the lines of dynamic hedging and being able to look into the potential ability to have a hedging model that aligns more broadly with risk management activities, including kind of enterprise risk management activities, rather than solely being limited for a one-for-one hedged item and hedging instrument relationship like we have today. Some other items that we flagged that we think would be helpful is continuing to look into the scope of ASC 326 as it relates to trade receivables. I mean, I think some of the recent guidance that came out is helpful. I think it went a little farther with private companies with being able to look at hindsight. I think that would be equally helpful to public companies as well. Additionally, another item that I understand has been coming up in practice that we flagged is looking at the accounting for settlements with vendors and whether or not there should be a different or an enhanced framework for the timing of recognition of those. Additionally, another item that we called out in the letter is considering whether or not we could build a framework for registrants evaluating preferability of accounting changes. I think some of the feedback that we got from members of our committee is that, in many cases, a company may have established an accounting policy 20 plus years ago when its facts and circumstances were different, when maybe regulations of statutory requirements in other countries were different. And it tends to be very difficult once companies are in to pivot into a different accounting policy. And part of that difficulty, we think, is that there's somewhat of a lack of a framework that we have for assessing that and presenting that to auditors and dealing with the preferability letter process. Another item that I wanted to flag that we'll be talking about in the meeting that actually wasn't in our letter because it kind of came up afterward that we think is worth addressing is my understanding is some long-term power supply agreements are potentially subject to derivative accounting. And apparently this is an emerging issue in some industries, and we want to provide some information about it as a potential item that could be looked at either as part of the board's agenda or maybe as even a narrow ETF issue. And then wrapping up with some of the items that we flagged that we did not think were necessarily high priorities for the board to address. I think there's general agreement on our committee that we don't necessarily think it would be an improvement in GAAP to move share-based, equity share-based payment awards to a variable accounting model. And so I think that's something that we would not recommend prioritizing. Day two accounting for goodwill is another item. I know that there's a lot of different views. I think our thinking is that each of these views has some issues or noise with it. There's been various analysis and discussion for some time. We're not really sure that there's an easy answer. And right now, the model that has expanded companies' ability to apply step zero, we think is generally manageable. And a lot of times the challenges are more audit-related issues rather than the accounting model itself. And I think the last item that we flagged that we would not prioritize trying to address would be seeking to harmonize VIE account or VIE consolidation model with the voting interest consolidation model. I think, in general, some of the thoughts for that is, well, can you get to a simpler model that still gives us the same consolidation answers? We don't think spending time to try to get to the same place is, the best use of the board's time. And it would create a big, paperwork exercise and some administrative stuff on behalf of, preparers as well, and trying to shift to a different framework that probably won't lead to different conclusions. So I think those were the highlights that I wanted to kick off, and maybe I can turn it over to, any questions from the board members or comments from the group before we start, diving in deeper on some of these items.
Maybe a question, Brian, about dynamic risk management hedging, and in particular, whether you've been following the ISB's project and have views on that at all, because we've certainly heard different things from stakeholders about how difficult it may be.
I'll turn it over to Kirk and Nate for that.
So trying to think of where to start. When one of the things that Nate and I agreed on is that we viewed that model as another tool, not necessarily something that would replace the existing model, but it would be a tool that would be useful for certain financial institutions. And one of the issues that you get into with some of the larger financial institutions is their risk management is fairly sophisticated, and it's at a macro basis. So Fannie, as an example, runs metrics on a daily basis related to the risk position and adjusts their economic hedges in the aggregate, not on a instrument by instrument basis. And so we have a fairly sophisticated model that then takes those economic instruments that we've put in place for hedges and figures out to what extent can we leverage the accounting guidance to put in place hedge accounting. And that's really Rich, you had asked kind of a basic question of, well, what is all this about at the end of the day? It's about the derivative side. Your derivative book needs to be marked to market, but you're hedging interest rate risk on loans, debt, and investments. And for the most part, your loans book and your debt book is at amortized cost. And so you've got volatility from marking your derivative book, but you don't have that corresponding mark on the risk that you're exposed to on your debt and loan book. And so people are using hedge accounting to try and level the playing field. Now, because for the most part, you're hedging interest rate risk on a mortgage loan, you can't just elect the fair value option and level the playing field, because then you're also marking the credit risk. So the challenge, if you will, with the ISB model is that, well, for your loan book, as an example, you have to separate out the component of the change in fair value that's associated with interest rate risk. Now, that problem exists in the current model. And the approach that they seem to be proposing is one that would require you to do that on a broader basis. But if I understand their proposal, or at least the public part of the proposal that I read, you're getting less into, well, is it highly effective? It's really more about presenting from a risk management perspective, what is the risk that you're trying to offset, and marking both of those components. And sure, there's going to be an effectiveness associated with that, but the assumption is that people would be willing to reflect that in their financial statements. Nate, do you want to jump in, because I don't want to leave you out of the game?
No, I appreciate that. I think that's very well said. And I would say we are similar to Fannie in that respect, that when we manage our balance sheet, we look at the structural balance sheet risk and the overall rate position. And so hedge accounting is a way that our treasury team looks to limit earnings volatility while managing capital, what's going through OCI. And with the model that the IASB is evaluating, we do think that there is some merit to that and could be closer in line to how we do manage our balance sheet risk and give our treasury folks, the opportunity to use that as a tool, but also I think provide our users with better information about how we are managing our balance sheet risk, which may not be coming through in today's hedge accounting model and disclosures.
Hillary?
Go ahead, Hillary.
Oh, sorry, I appreciate the feedback. And I think it's interesting because when I think of the different types of feedback that we get on hedge accounting, it's a spectrum, right? You
Yes.
get very detailed, specific questions for this particular hedging strategy. Can you make this work under the guidance? We get all the way to, we should completely relook at the hedge accounting model. And that's where I think the question comes down to, is it trying to fix a mismatch, or is it trying to provide a better reflection of the entity's risk management strategies on a totality basis to investors? And I'm not sure those two always match up for all instances. But the dynamic risk management one feels somewhat in between to me, right? It's a kind of an addition onto the existing hedge accounting model. And I'm not sure that I've heard a lot of interest in adding on more to the hedge accounting, making bigger changes, but keeping the existing model versus trying to relook at the model and address some of the bigger challenges that we have related to documentation issues, related to instances where you have de-designation events that don't make economic sense because you still have a highly effective hedging relationship. Are there other ways that we could address this to try and, I think, address some of the same points that you have, but maybe be able to do it a bit more holistically? I think one of the things I've thought about with the DRM, or the Dynamic Risk Management project, is it's more focused on interest rate risk and for banks, right? And I think one thing as a board member, when I think about if we're going to relook at the hedge accounting model, this is just a personal perspective, but I would like to be able to see if there's opportunities to make enhancements across industries that apply hedge accounting, whether it's for interest rate, whether it's for credit, whether it's commodities, and thinking about where are some of those challenges that we have today, and are there opportunities for us to address those challenges and relook at the hedge accounting disclosures, because I think Fred will certainly jump in with regards to how those disclosures are likely not providing decision useful information from investors. But I think it's really helpful because it's a big type of project. So I think there could be multiple different ways that we figure out, what's the path forward. So I really appreciate this perspective.
Oh, I just have follow-up questions in line with Hillary's, what Hillary just said. I guess, first of all, your comment letter did kind of refer to DRM. Does that mean what you're requesting in terms of our agenda is a bank interest rate specific hedging issue? Or, as Hillary suggested, we hear a lot from insurance companies, we hear a lot from ag companies that the overall model's broken, not just for the banks. So I kind of a question for you, is your request really focused on banks and interest rates, or are you open to broader?
So the financial institution representation on this committee it is two very large financial institutions that from a hedging perspective have fairly sophisticated strategies. The part of the problem with hedge accounting is that what Nate and I might be really interested in is not necessarily something that a smaller financial institution is going to be interested in, because there are a lot of small financial institutions that are, from an economic perspective, doing one by one. They're hedging individual financial instruments, and maybe don't have the resources available to create some sophisticated model to be able to try and offset aggregate positions or even put aggregate positions in place. So Nate, I presume that most of the risk that you're hedging on your side is interest rate risk as well. Is that a fair assumption?
Yeah, that is a fair assumption, but I do think Hillary's comments resonate with me. And just to be transparent, as we were going through the process of drafting the committee's letter, we did discuss whether we should encourage the board to kind of start from scratch with the hedge accounting model. But as Kirk was saying, we acknowledge that there are organizations and institutions where the current model is working. So, we didn't necessarily want to rock the boat there, but just kind of point out the opportunity for improvement that we saw.
When we looked at that model, a couple things, observations. It's taken them almost 10 years to get to an exposure draft, right? So one, the journey wasn't a short journey. Two, the other observation was, well, does this give them a tool that the US-based institutions don't have? Yep. That even from the perspective of providing transparency to the users of the financial statements might be a preferable answer. One of the things that we personally struggle with is it's hard to look at our if you were to pick up our financial statements or the financial statements of any other large financial institution and say, well, if I'm just the layman, you talk about hedge accounting, but show me in the financial statements what's actually happening. I think it would be difficult for somebody to pick that out. And, I can tell you that I'm a part of conversations with people that are in the know that kind of struggle with, well, what is it? How is it actually offsetting your volatility? And show me in the financial statements how it's offsetting the volatility. The model we have today doesn't really do a good job of presenting that. It seems like the direction that this model is going is not just about the offset, but it's also about how it's presented and giving an alternate to the presentation. I do agree that because before I came here, I went through, all the other large financial institutions or other, the big four firms and some boutique firms that weighed in on this particular question. And it was kind of interesting because we all agree something needs to be done. We just don't agree on what needs to be done. Yep. So the invitation to comment, in my view, said, well, hedge accounting should be on your list, but there wasn't a consensus on what the solution is.
Yeah, and going back to Nate's point, the original position was let's just holistically reconsider hedge accounting. And having been involved in hedge accounting issues going back to when Statement 133 was originally issued many, many, many years ago, I think the board has made substantial improvements to the model, making it a little bit easier for commercial companies to actually do hedge accounting. And so I would hate to have the board complicate their lives by trying to address, the issues that Nate and Kirk are talking about, and that other large commodity dealers are dealing with. It kind of seems like there ought to be room for both, and providing a dynamic risk model that would apply to companies on an optional basis would be one way to do that. Trying to do a one-size-fits-all model, just go back to ASC 326 and say that's a one-size-fits-all model and it doesn't fit all. So that was identified originally for banks, but it's been applied to commercial companies and it's not a great model for them. So that's why I thought it made sense to carve out a dynamic risk model that would be optional.
I know, Rich, you asked earlier, like, what do folks think of hedge accounting and what is it? And I think where you go kind of depends on how you look at it. If you look at hedge accounting as wanting to faithfully represent an entity's enterprise-wide risk management activities, it's one thing. If you're saying it's essentially a model for synthetic instrument accounting when you're using a derivative to change the characteristics of another derivative of another instrument that's not measured at fair value, then it's a different thing. And I guess trying to decide between those two when both of those objectives are out there is probably going to be part of the challenge of the project.
Quick follow-up for Nate. Nate, because you guys referred to the ISB project, how important for a global bank is global convergence on such a model, given that you guys compete globally?
Yeah, I think it is important. As Kirk alluded to, it would put us at somewhat of a disadvantage if we have a different model that is not as good at portraying our risk management as perhaps what the ISB offers.
Okay, anything else on hedging? Maybe I'll kick it over then back to Jeff to talk a little bit about business combinations and asset acquisitions.
Yeah, so one of our comments is that we do think the board should add a project to harmonize the accounting between asset acquisitions and business combinations. Particularly since the effective date of ASU 2017-01, we're seeing a lot more asset acquisitions, but there's a lot of unaddressed issues, and that creates issues in practice. As Brian acknowledged, you guys had a project at one point in time. You tried hard on it and decided it wasn't going to come to anything. We think this one, more so than consolidation, probably bears trying again, just given the prevalence in these types of issues. We also don't think, or we would like not to have new differences created with IFRS 3. So that kind of suggests maybe moving asset acquisition accounting closer to business combination accounting so that we're not triggering a lot of differences from the IFRS standard on business combinations. We listed in our letter a number of areas that we think should be addressed: contingent consideration, non-controlling interests, income taxes, employee benefits, revenue arrangements, contract assets and contract liabilities or deferred income.
R&D.
Yep, IPR&D, measurement period, assembled workforce, transaction costs, and bargain purchase. Those are the ones we specifically listed. There may be other ones, but those are the ones that seem to be driving the majority of practice issues. And we think, recognizing again that it's been tried before, maybe going into it with a focus of not creating new differences to IFRS 3 on ASC 805, that might help a little more.
So just curious, and let's try IPR&D. And we just did a software standard, right, where we heard pretty clear feedback from preparers and from investors. They weren't looking for a lot of development costs to go on the books. So when it comes to IPR&D, I guess it's already converged with IFRS 3, right? That you establish an asset and a business combination. And you mentioned go towards BizCom accounting. Does that mean capitalizing internally developed intangibles, including software?
If the acquired entity is not a business, but it has internally developed intangibles that, if it was a business, would be put on the balance sheet, it does seem like consistency would suggest you should record the same asset for an asset acquisition.
So do you differentiate between some definition of an asset acquisition versus buying the intellectual property by itself versus outsourcing the development of intellectual property to a third party, maybe through contract labor? versus having your own labor do it? You view, there's this, I'm getting the sense that, so let's go back to software. I can have my own people write the software.
Mhm.
I can outsource it to a third party to have contract labor write the software. Or I could buy that in-process software with some other asset, maybe with this pen. Or I could buy it with something else or a business. Is there some subset of those transactions that you think should be the same as the BizCom and others that shouldn't?
That would be a good question for the board to decide and get feedback on.
And that's been one of the challenges with going to the BizCom model.
Mhm.
Because our definition of an asset acquisition, theoretically, any asset that's produced is an asset acquisition.
Right.
Do you think if we move BizCom accounting to be more consistent with, it doesn't matter how you acquired the asset, you should have the same recognition threshold? So software, if you built it yourself or you bought it partially built, you should get the same accounting, which maybe to have expensed it over time or expensed it at the date of acquisition. That would be moving away from IFRS 3, but that would be at least consistent amongst GAAP. Is that something that IMA would reject?
Yeah, I think that would be, I mean, I think our concept is let's not create any differences with IFRS 3 that don't already exist. And so if you're creating a difference to solve this issue of what's exactly in scope, I think that's not what we're looking for.
Okay.
Well, but I mean, I would say, Jeff, would it be fair that people might have different views? Like we, for example, don't have pharmaceutical industry, I don't think, representation on our committee. And I assume if you ask folks from that industry, they'd probably be more inclined to, the IPRD expensing model because of the tracking burden on all the molecules and things. But I think I agree with, I think we're in agreement that we shouldn't have these differences or they should be minimized. I think one other item, my personal view, I think one of the accounting rules that is least representative of the economics is how we do contingent consideration. It's a situation where if the business you bought is doing great, your earnings are hit. If the business is doing really bad, you get a credit coming through the P&L, and you're basically accounting for it as derivative financial instruments. When in reality is two parties couldn't agree on what the purchase price was because they have different expectations of how the business may perform. So they say, fine, we'll agree that based on how it performs, that's what the final purchase price would be. So to me, I always kind of think of the old model of contingent consideration or the way asset acquisitions do it as representing what the parties of the transaction agreed with. But I can't speak that, we didn't necessarily align as a committee. Does everyone agree one way or the other?
Yeah. And maybe one way of thinking about it is eliminating differences where possible, but not necessarily fully aligning all the models, because if we fully aligned all the models, we'd probably change inventory accounting or how you acquire inventory, right? We would change a lot of things. Okay.
All right. Anything else on asset acquisitions versus business combinations? All right. Maybe pivoting a little bit from the agenda consultation to the invitation to comment. I don't know, Carla, if you can maybe talk a little bit our views on intangible recognition.
Sure. And it dovetails right into the IPR&D discussion. So this is a very broad project, right? Intangible assets, but the committee is generally supportive of adding a project related to intangible assets to the agenda. Now, part of it is because this recognizes the importance that intangibles have in driving the global economy and global financial markets. There's no doubt about it, and it's only going to get even more noticeable, the difference between a book value versus something like internally generated that is related to intangible assets. But this is a very challenging project. And as you were talking about earlier, we probably don't want to have a project that lasts 10 years. So our suggestion was actually to start slowly, start with the phased approach, by providing a framework to improve disclosures around intangibles. And what you learn from it, decide whether or not there should be another phase on whether to recognize some internally generated intangibles. So at this point, we're not recommending as a group to change the recognition and measurement of internally generated intangibles or intangible assets in general, except for we do have like a couple of exceptions, which we noted. One was, IPR&D or, that the asset versus business combination. And the other one might be emerging issues. Like you have been dealing with digital assets, cryptocurrency, that's a big area that you should continue to focus, or environmental credit. So as they emerge, you do those targeted improvements or targeted projects. But in general, we think that there'll be areas where you could use information that management already has when running the business that would be helpful to investors. So examples could be, well, one is an explanation of what is that R&D, if we're talking about an R&D material business, what is that, how does that connect with the strategy? How is that helpful in generating future cash flows and future value to shareholders? So part of that is if R&D is material for the particular preparer, can we disclose, for example, information like what is maintenance versus new R&D, or what is the difference between research versus development? Or if, where are those items located in the financial statements? Where can we find them? And we do acknowledge that part of the DICE and the segment reporting projects could provide some of that information, but it may not. And so to have, make sure that there's no duplication of efforts, because that's not something preparers like, right? But that could be something that would help investors, because even if we're thinking about whether or not to consider to fair value an asset, if we don't know which information is available, it's very hard to make an assessment of whether or not I should be making. So if you ask investors in general, they probably will tell you, like, I don't want a fair value on the books right now because I don't understand what's in there. So the idea is more like, can you tell me more about the expenses that you're incurring? Are they for new projects, new assets that you're creating, or just maintaining the existing ones? Or are they, how is the value going to be created? And this could be applicable also, for example, for strong brand businesses where you are some of the selling expenses, selling and advertising, et cetera. Some are to maintain existing brands and some are to create brand new ones. So, for example, if we're valuing a brand, that's something we look at. We look at how much is it just to maintain versus you're creating a new brand. So some of these items could be an area that could help investors in trying to ascertain how much value you're creating with these assets. But similar to what Jeff was saying with the asset versus business acquisitions, or even with dynamic hedging, that this is an area that you probably should have some collaboration with the IASB. They have added that project to their research agenda as well, and business combinations are very cross-border, global in nature. And I hear from project teams in our firm that causes a lot of angst, like trying to reconcile companies that have, preparers that have obligations to file under IFRS, under local jurisdictions, and then under US GAAP here, and trying to reconcile the differences in the business combination, particularly like when it comes to certain of these assets, like that's something that they would not want to go back and having significant differences for any project. So I think that's a summary of. Any questions?
Nothing.
Do you,
Okay. Go ahead.
when we say intangibles,
Intangibles, yes.
do you think we'd be better served by dealing with subsets of intangibles than dealing with the category of intangibles?
So we talked about, for example, the business combinations. 805 does have types of intangibles that it distinguishes, right? And the nature of disclosures will be different. What you care about as an investor, as a user of financial statements, will be different if you're talking about technology, research and development, et cetera, type assets, versus if you're talking about marketing based versus customer. So it does, and of course, all of this is predicated on, is it material for the business?
Mhm.
We just think that expectation wise, value drivers are probably going to be more associated with intangibles that are related to technology and maybe marketing, that those are going to be areas that will be growing significantly, will continue to grow. But our idea was, or what we discussed was providing a framework of disclosures. Like, here's a framework to address different types of intangibles. Go ahead, Kristen.
Rich, maybe I just offer, I think you can do things piecemeal. My only caution is that then, is there an overarching framework? Because as business models evolve and you're in between two, and if you take it too far, then we have this patchwork of models. And at some future date, do you have to then consolidate models because there are differences? So I think you could do it if there was a framework. You were talking framework of disclosure, but I think framework of recognition and measurement that was guiding so that you don't end up in a whole bunch of patchwork that has inconsistency potentially.
So for example, some might say an assembled workforce is an intangible. Some might say an FCC license, software that's being developed for whether you're going to sell it or you're going to provide it as a service. I get it, but I do wonder if you have the same interest in disclosures about an assembled workforce as you do about product advertising and product development.
I think that's a good point because, for example, workforce will be very material for a professional services type business, for example. Some of those that are people driven, you would value more those types of disclosures, but for a great majority of businesses, that assembled workforce is maybe not as relevant in terms of disclosures around that.
Christine's been waiting here.
Thanks. I was writing my notes. So I struggle a little bit with the notion that intangibles should be lumped together. We don't have one standard on tangible assets, right? We got a PP&E standard, we have an inventory standard. So I think to Rich's point, I have a really hard time thinking about just one standard for them all when it comes to intangibles, because they're equally as unique in how they can create cash flows, how they're used. A crypto asset is going to, like Bitcoin, is going to generate a market participant cash flow, whereas a patent on something I'm using in the production of a product is completely different. And to me, they shouldn't even be measured the same way. So I don't know how I would think about putting all of these together. But the other comment I had was just, we just said, well, we need a framework for recognition and measurement, and we need a framework for disclosure. Well, I would say that's chapter 5, chapter 6, and chapter 8 of the conceptual framework, because we have chapters that provide a framework for recognition and a framework for measurement and a framework for disclosure. And so what I would like to take from your comments is that the board should be thinking carefully now that that framework is done, trying to figure out how what's in those chapters can help us think through some of these issues. And I think we will take the recognition principles and apply it to two different types of intangible assets. Same recognition principles, you may get to different answers about whether something can or can't be recognized. But that's the purpose of the framework. And so, I think we do have a framework. So we just now need to use it.
Just be mindful of time. If anyone have any additional. Go ahead.
Maybe one thing to think about, and
Yeah.
I'll have to answer it here, is we have a definition of R&D. We have a definition of advertising, both of which are, in my view, fairly outdated. Our R&D definition is based on R&D for products you'll sell versus products you'll use to generate all your revenue. So look at the financial institutions making huge investments in technology, expensing and capitalizing some, doesn't fall into R&D, right? Even though it might be the most cutting edge system ever. Advertising is advertising, it's not marketing. And I'm sure my guess is some of you folks spend more on marketing than you do advertising. So the question is, should we look at those definitions as a starting point on any kind of disclosure project? And would that possibly be helpful in updating those definitions? Just curious.
I mean, I don't know that we've discussed it as a group. I mean, it seems like modernizing outdated definitions like that seems like it could be helpful, but obviously there'd be a lot of work and evaluation of the impacts and stuff.
I would just add that we were very cautious about rushing to recognition and measurement until we had a better understanding of how to break down the larger category. And there were probably mixed views in the committee around, do you even get to recognition and measurement, or is it purely disclosure at the end of the day?
I did want to, anyone else have anything else on this topic, intangibles? Okay. I did want to kick things over to you, Eric. I know you had a couple items. Every time I'm ready to turn it over, they're in their computer. So sorry about that.
Oh, no, it's fine.
So I think, the first item, which we did raise in our letter, has to do with which, I hadn't really thought about before, but it is, something you run into a practice a lot, is framework for evaluating preferability of accounting changes. I mean, I think probably like a lot of other preparers, I kind of feel like an accounting policy is like you're in the Hotel California. You could check in, but you can never get out. And so I think, Eric can expand on that a little. And then I think also you were able to share another emerging issue that.
Sure. Yeah, related to power purchase contracts. As you probably all know, Amazon did submit a response to the invitation to comment. Sorry, we missed the cutoff date and only submitted a few weeks ago, but I was given some reprieve by the staff who said that was okay. With respect to accounting changes, at least some of you may know that we have found it incredibly difficult to change certain practices in our accounting, specifically as mentioned in our comment letter to you all, related to the accounting for forfeiture rates of share-based compensation. When we adopted our accounting policy to estimate forfeitures of share-based comp, it was adopted at a point in time that made sense for the company. What we have found is the company has evolved and there's increasing complexity, and not only within the company, with the advent of Pillar 2 and a requirement to create separate standalone financial statements for certain legal entities. The operational burden of continuing that practice is fairly significant. Because of words in the basis of conclusion, some would read those words to say it is never preferable to change your accounting policy to recognize forfeitures as incurred. I think that's a micro example of a larger problem. We would encourage the board to think about both of the problems. That is that what the board's intent was in a simplification project on share-based compensation to not allow a company to change their approach for recognition of forfeitures? It seems when I read the basis of conclusion, that's not the correct interpretation in light of a simplification project. Practice seems to have a different view on that issue. But it goes to a bigger point that I think the board should also consider, and that is, how do you think about accounting changes? It becomes a very difficult discussion with your auditors when you may have a different opinion about what is preferable. And how do you evaluate preferability? What is the relative weight you should give to the factors? And there's very little promulgated on how you should think through that. And it makes a conversation very difficult to engage in. I think it becomes a matter of subjective opinion versus how do you really think about costs? How do you think about information utility and so forth? So we think both of those projects are worthy of the board's attention. Happy to take any questions or certainly, have a sidebar discussion with anyone at a later point in time.
And Eric, take those points, right? And certainly, I think it's great feedback to get. I think there's also been questions that we've received with regards to accounting. What is an accounting change? If it's a change related to presentation or a change related to disclosure, does that get caught into it? So yeah, I do think it's fair feedback to say we haven't looked at that guidance in a long time. Is there a way to look at it and make it more operable? I also think in your letter, I believe you guys made a point that maybe looking at the existing guidance today where we have we've effectively given accounting options, but then we say one is preferable. Is that something that should continue? That was something we did historically. I don't think we're trying to do that anymore, but is that fair to kind of relook at that? I think that's fair feedback, but certainly an area that we haven't looked at, but questions come up frequently with regards to how do we interpret that guidance?
Yeah. And some other challenges too, if you kind of think how this interacts with the SEC requirements for a preferability letter, we'll just say you're a big four firm. Once you've got a decision on what's preferable, it's kind of like the rest of your client, they can't be sending in presumably letters back and forth saying that's opposite thing is preferable over and over. So whereas the facts and circumstances for a particular company may make one thing preferable in the context of costs and benefits and needs of their users and things of that nature. And potentially if there's a framework in GAAP that maybe acknowledged that the determination of preferability could vary on a company basis, that would prevent folks from being locked in as much. And I think to Eric's point also too, is it a great idea to be putting in standards, which item is preferable? I mean, I think if you look, an example that probably most folks would initially agree with, pensions, right? Most folks would think that, well, taking the pension volatility each period is preferable. But if that's the case, why doesn't any company do it? And why aren't investors, demanding companies do it? And to me, that would be like, well, if I went in the bank to apply it for a mortgage and they asked me how much, my salary is, and then I added my gains on my 401k unrealized appreciation last year and told the banker, well, but don't worry, that's preferable. So it's not always clear that some of the stuff that we default to as preferable are always, and even if you take the forfeiture example, like it seems like estimating forfeitures versus not estimating them, like it's preferable to be close to the right answer than precisely the wrong answer. But you also, I think intuitively, every company I've worked where we've had a senior leader leave, the immediate reaction from everyone is, okay, well, what is the credit coming through for all the equity that they forfeited? Because intuitively people expect that, yes, if someone leaves and you no longer have an obligation to them, presumably there's a P&L impact of that. And yet if you're estimating, you have to say, sorry, we don't get any pickup because it's already baked into our assumption. It's smooth. And in that case, smoothing is preferable, but in like a pension case, smoothing is not. So I don't know that all this stuff is as easy as it comes out to, and having one right answer.
And I can quickly touch on the power question that's coming up. And I don't think it's an issue that's unique to Amazon. I think many large companies that are looking to procure power out there are starting to face these. What we're finding is contracts for energy are resulting in larger and larger commitments with longer contract terms because of the desire to secure power with an unknown demand forecast to some extent. And so you start to enter into contracts with fairly significant capacity commitments, as well as also in the same contract, a contract for energy. What you find in these markets is there's always going to be net settlement for some of the contracts. Power usually settles actually by the hour, I've learned. So you'll end up with net settlement provisions. Given the large amount of capacity that's contracted for too, a company may not ultimately need all of that capacity. It's not entered into for speculative purposes, but you'll see net market sales whereby the consumer, the actual original consumer or signatory to the contract procuring the power, will get some benefit from the sales into the market. And it's really the substance of this is you have a utility producer who needs money and massive infrastructure and needs security that there's going to be an off-taker for the energy. And you have a retail consumer, to use loose words, that wants energy and needs to get massive commitments for it. But there's some risk there as well. And so the intent of the contract isn't to speculate in the market on energy prices. And if you find yourself with net settlement provisions, which kicks you out of the normal purchase, normal sales, you have a derivative. And then you have a derivative on an energy contract that could span 15 or 20 years, which is new, and the energy curves don't go out that far. So you're forced with level 3 valuation measurements on a contract for which you have to build what's referred to as a fundamental curve to determine what the price of energy will be 20 years out. So there's a lot of complexity that comes up, and it will become very difficult to explain the reporting outcomes, not only to our senior leaders, but I think to investors on what those contracts really look like. And one of the observations that we would have is if you look at VPPA, virtual power purchase agreements for solar and wind, simply because there's no notional, you don't end up with derivative accounting, but those are all net settled. And so there is a disconnect in the logic. I understand the solar power and wind power concept, but we're finding ourselves with an increasingly challenging and complex financial reporting problem because of the nature of the power industry, the nature of power itself, and the need for commitments so that power can be developed. It's not just Amazon that's faced with this. I've anecdotally talked to a couple of my peer groups. They have the same problem. We're continuing to collaborate as an industry, but wanted to at least get our thoughts out there in connection with this ITC process. I suspect you'll probably hear from others on this issue as well, but happy to take questions or, sidebar with anyone on it.
Hey, Eric, if I might add a little bit to the summary over there, I think you did a fantastic job being on the seller side of those contracts institutionally as a utility. Maybe the only thing I'll add is that because of the nature of power, and the longer it goes out, we don't typically the industry doesn't have curves or predictions beyond really the next 5 years, right? And even that at best is fuzzy. So the impacts for what you might need to create on that side if you were scoped out of normal purchases, normal sales. And that may be the case because of net settlement. It also may be the case because of just inherent default provisions that are required from buyer and seller that may look like a net settlement clause. That type of estimate that has to go beyond between year 5 through year 15, typically we'll do 15, 17, 20-year power purchase agreements and in quantity commitments. That impact becomes extremely significant and material, and at the same time harder to explain to senior leadership and to shareholders who understand the industry but don't understand why we're subject to fitting in the square peg in a round hole. So well said there, and happy to sidebar on that as this becomes a lot more critical to a lot of C&I clients.
Yeah, thanks for your comments. And one of the things you said was, penalty provisions and termination provisions. And I think one of the challenges with the literature is you can find yourself with a contract where you have no notional for the actual electricity, but given some of those provisions that may be tied to capacity, I'm not sure that practice understands the unit of account or has agreement on the unit of account for how do you think about the energy contract and the capacity contract within a single contract here. So that adds more complexity to the analysis.
Eric, you said net settlement. Do you have an ability to net settle them at any point in time?
They net settle by contract every hour. So
So you can settle the entire 15-year contract.
no, it
No.
settles. No, so the contract.
I understand, just the net settlement on the purchase. Yes.
Yeah, no.
Correct.
There's no termination provisions in the contract.
It depends on the contract. Some of the contracts could have termination provisions. Others may not.
And the ones that do, is your fair value generally the same as the termination value?
I would have to check to be certain to give you an answer on that one.
Yeah, generally how we've seen these sized, Rich, is that the termination value actually is tied to, in some cases, something completely different. It may be actually tied to a component of the seller's exposure to the underlying asset that required the offtake security of the buyer to begin with. So it's a function of that rather than the commitment, because it's almost impossible to forecast some of the quantities and commitments, and certainly on a pricing side.
Thank you.
Okay, just we're very close to the end of our time. I don't know, Laura, and if you could maybe very quickly, talk about talk about the issue with settlements with vendors.
Yeah, I'll try to do it really quickly because I think Mary still has some things to talk about. But I know at the agenda consultation says that it relates to the airline industry, but as you can see in some comment letters, not just ours, it relates to other industries besides the airline industry where you may get components, particularly if you're a manufacturer or distributor, you're getting components, they have quality issues. You then get in a dispute with your vendor that can take months, if not years. And you are faced as the manufacturer that relies on that component, you have to fix it yourself. So if you don't, you're going to have lost revenue, you're going to have increased cost, and you've got to mitigate the problem immediately. A lot of times you pause the relationship with the vendor or you cease the relationship altogether. And then you may, months, years later, enter into a settlement arrangement. And you may or may not pick back up that relationship with that vendor at that time. But I think the question is not the classification and whether it fits into 70520 in terms of it being a reduction of the cost to inventory, but it's more the timing. And a lot of people feel that the economics, the accounting, and some of the answers that we get from the accounting firms, because there's no US GAAP guidance on this, is that you delay that recognition when it relates to a past event. And sometimes, again, a past event with a vendor that you no longer have a relationship with. And so we question and would like the FASB or perhaps the EITF to take this issue up in terms of timing of that recognition.
And we're happy to provide any follow-up information on that. But I think we're pretty much out of time for, I think the last agenda item was going to be talking about, I think, the 3 or so items on the technical agenda. So I just connected with Mary and we thought maybe we could just open it up if anyone has any questions for the FASB staff on any of those projects, or if the staff has any questions for us about any aspects of those. Happy to.
I don't have any questions, but I think you probably saw in our comment letter on KPI metrics that we really felt that you should marry whatever you end up doing with KPI metrics, which I know a lot of people don't think that that should be a priority. And in this room, we all kind of agree and disagree on that. But please think about marrying it with the cash flow project. I will tell you, as a former chief accounting officer of a large public company, the top 3 problems that came to me were cash flow. Where do I put it on the cash flow? Revenue recognition and vendor disputes. So funny that these are all kind of top of mind, but again, just if you could keep that in mind when you're looking at those 2 research projects.
Okay, I think we're at the top of the hour, so I just wanted to thank everyone again for joining today. And, we look forward to the next time we can all get together. Thanks very much.